Hi, this is David Hardesty, and in this lecture we will continue our discussion of website development costs by examining the tax accounting rules for the cost of website software. Before studying this lecture, make sure you have already studied the following lecture, Lecture 2-1, Overview of the Accounting for Website Development Costs. The objectives of this lecture are to identify software in websites, differentiate between software development costs and the cost of purchasing software, accounting for software development costs as Section 174 costs after December 31, 2021, accounting for software development costs as Section 174 costs before January 1, 2022, and the special accounting rules in Revenue Procedure 2000-50. The first thing we need to know is what portion of website development costs represent the cost of software. Software is generally defined as a computer program designed to cause a computer to perform a desired function. This definition is found in IRC 197E3B and Revenue Procedure 2050. Software is often written as text, so one might mistake text that is software for text that is website content, which we will discuss later. As a rule of thumb, you can identify text that is software because it is written in the form of instructions, which are read by a computer and which tell the computer what to do. Website content, on the other hand, contains no instructions telling a computer what to do. That is, content is passive. Content takes the form of text, photos, graphics, video, or sound. When content is displayed in a website, it is the website software that sends an instruction to the computer to display the content. Content has no power to initiate its own display in the website. For example, a photograph cannot display itself in a website. It is the website software that must send an instruction to the computer to display the photograph. Here's an example of software in a website. Rodriguez plans to sell Spanish porcelain tiles using the internet. His website will be called Spantile. He contracts with a website programmer to create his e-commerce website. The programmer purchases and installs off-the-shelf shopping cart, a data management software, which will be used to track the tile inventory, display pictures, descriptions, and prices for tiles for sale, and take and process orders from computers. This is all software because its purpose is to and function is to cause a computer, in this case a web server, to perform a desired function. This example is continued on the next slide. The pictures, descriptions, and prices of the tile inventory, on the other hand, are content. Content is passive and is used by the computer to create the images and text on the website that the customers see. Once we know that we are dealing with the cost of software, we must know whether the software was purchased or developed. This is because the cost of purchased software is capitalized and amortized, whereas the cost of developed software can be either capitalized or currently deducted. Let's first look at the identification of acquired software. Obviously, if a taxpayer goes to a retailer or other supplier and purchases a copy of a mass-produced software product, the taxpayer must treat this as purchased software. In addition, if a taxpayer contracts with a third party to develop custom software, that the taxpayer may have, then the taxpayer may have purchased software. On the other hand, depending on the terms of the contract, the same taxpayer may be considered to be engaged in developing software. How do we determine if custom software is purchased? Where there is a contract to develop custom software, if the developer bears the development risk, then the taxpayer is deemed to purchase the software from the developer. And where the taxpayer bears the development risk, then the taxpayer is deemed to develop the software. In general, development risk is borne by the person who must pay for the cost of developing the software, regardless of whether that software works. For example, if a taxpayer contracts with another for the development of custom software, but must pay for the software only if the software works as planned, then the taxpayer is purchasing software. On the other hand, if the taxpayer must pay the developer for work performed regardless of whether the software works, then the taxpayer is the developer of the software. Here's an example of software development costs versus purchased software. In the previous span tile example, assume that instead of buying off-the-shelf software to run the website, Rodriguez decides he wants custom software. So he hires a developer, DevelopCo, to create both shopping cart and data management software. Whether the software that gets created is characterized as developed or purchased depends on the contract with DevelopCo. This example is continued on the next slide. Assume that the contract with DevelopCo provides the exact specifications of the software, the exact price of the contract, and contains a provision that says Rodriguez does not have to pay for the software unless the software meets all of the specifications of the contract. In this case, DevelopCo bears all of the risks of development, because if the software does not work, it does not get paid. In this case, the acquisition of software will be characterized as a purchase of software. This example is continued on the next slide. On the other hand, assume the contract provides exact specifications of the software, but no fixed price. Instead, DevelopCo is paid by the hour. In addition, the contract provides that DevelopCo gets paid for its efforts, even if the software does not meet the specifications of the contract, so long as DevelopCo puts forth its best efforts to achieve these specifications. In this case, Rodriguez assumes all of the development risk, and the acquisition of software will be characterized as software development. What are the basic differences between the accounting for purchased and developed software? Purchased software is capitalized and amortized. Amortization is over 3 to 15 years, depending on the nature of the software and the manner of acquisition. In addition, there is a limited amount of bonus depreciation available for purchased software. Developed software may be capitalized, currently deducted, or amortized, as we will see in the following discussions. The specifics of capitalization, deduction, or amortization of software development costs may depend on whether Section 174 or Revenue 2050 apply to the software and whether the taxpayer is subject to Section 195. Now let's turn to research and experimentation costs under Section 174 as they apply to software development costs. Section 174 costs are research and experimentation expenditures incurred in connection with the taxpayer's trade or business, where the taxpayer intends to use the software in its business. The costs must represent research and development costs in the experimental or laboratory sense. Expenditures represent research and development costs in the experimental or laboratory sense if they are incurred for activities intended to discover information that would eliminate uncertainty concerning the development or improvement of a product. Uncertainty exists if the information available to the taxpayer does not establish the following: its capability for developing or improving the product, the method for developing or improving the product, or the appropriate design of the product. Let's now discuss software development costs treated as research and experimentation expenditures in years beginning after 12/31/21. For tax years beginning after 12/31/21, any amount paid or incurred in connection with the development of any software is treated as a research or experimental expenditure. The only requirement for treatment as R&E expenditures appears to be that the costs are for software development. Modification of software, for example, may not qualify. Such costs are capitalized and amortized over 5 years, 15 years for foreign R&E. Amortization begins with the midpoint of the year in which the costs are paid or incurred. For years beginning before 1/1/22, software development costs could be treated as R&E expenditures only if they met the general rules for R&E costs. Software development costs could be R&E costs if the development activity met the requirements for R&E under Section 174. Before January 1, 2022, however, Section 174 made no mention of software. The costs must be for software development. Modification of software, for example, may not qualify. At the election of the taxpayer, such R&E costs could be capitalized and amortized over a period of 5 years or more, or the taxpayer could elect to deduct all such R&E costs currently. If the taxpayer chose to amortize, amortization begins when the company begins to realize benefits from such R&E. Here's an example of software costs that meet the definition of R&E costs. Assume the Span Tile website has been launched and is a great success. It is also is so successful, in fact, that Rodriguez has had to hire a number of people to process orders. He wants to automate this process, so he hires Alvarado, a recent graduate of the Harvey Mudd College, and a software genius. Between the two of them, they conceive of a software system that will completely automate all facets of the tile ordering and delivery process. At the outset, Alvarado is uncertain as to whether the software can be developed, and she is not sure how to develop the software or what the final design will look like. Despite these uncertainties, both she and Rodriguez believe that Alvarado will be successful in creating the software. Based on these facts, the cost to develop the software will likely be R&E costs. The costs that qualify under Section 174 can be either direct or indirect software development costs. Direct costs include the cost of materials and labor directly related to the research and development activities, such as the cost of the labor of software programmers and designers, and the cost of materials directly consumed in the development activity. Qualifying indirect costs also include costs reasonably related to the research activities, such as heat, light, power, and depreciation and other occupancy costs of a building used for research activities. Other qualifying indirect costs, including legal fees, office expenses, and overhead. Here's an example of direct and indirect costs that qualify as R&E costs under Section 174. Span Tile's employee, Alvarado, has been assigned the task of creating software to control order processing. She is given an office, computer equipment, and an assistant. Obviously, all of the compensation paid to Alvarado and her assistant qualify as R&E costs, as do the indirect costs allocable to her office, including utilities, depreciation, and rent. Any legal fees incurred to file for patents on the software will likewise qualify. In addition, an allocable portion of general and administrative expenses will qualify as R&E costs. For a startup company, qualifying software development costs as Section 174 costs presents a major advantage over accounting for such costs under another section. Section 174 overrides Sections 195 and 263. This means that any deductions available under Section 174 can be recognized even if Sections 195 or 263 would require capitalization and amortization starting after active business operations begin. For years beginning after 12/31/21, any amortization recognized under Section 174 for software development costs can be deducted during the startup period prior to the date active business operations begin. If, prior to January 1, 2022, the taxpayer elects to deduct software development costs under Section 174, those deductions can be recognized even during the startup period. Here's an example of the accounting for R&E costs. In the Span Tile example, we have learned that the company is incurring certain R&E costs to develop order processing software. How should it account for these costs? For years beginning before January 1, 2022, Span Tile can elect to deduct the cost currently, even if it is otherwise subject to Section 195. For years beginning after 12/31/2021, Span Tile can deduct amortization of the software cost even if it is otherwise subject to Section 195. Software development costs that are not Section 174 costs may be treated in a manner similar to Section 174 under Revenue Procedure 2050. Ordinarily, software development costs that do not meet the requirements of Section 174 can be accounted for under Revenue Procedure 2050. This rule seems to apply primarily to years beginning before January 1, 2022, since after 12/31/21, Section 174 fairly broadly recognizes software development costs as R&E expenditures. Revenue Procedure 2050 permits taxpayers to treat software development costs in a manner similar to Section 174. This means that at least for years beginning before January 1, 2022, taxpayers have the option to either deduct software development costs currently or defer and amortize these costs. It is not clear how, if at all, this rule would apply after 12/31/21. The treatment of software development costs under Revenue Procedure 2050 is very similar to that under Section 174, except for one important point. Costs deducted under Revenue Procedure 2050 are deducted under Section 162. For a startup company that is subject to Section 195, this means that such costs, while deductible pursuant to Revenue Procedure 2050, must still be deferred and amortized under Section 195. Here's an example of software development costs subject to Revenue Procedure 2050. Spantile has been in business a few years and has become quite successful. So successful that Rodriguez is having a problem keeping his accounting straight. Prior to 1/1/2022, he contracts with and pays Lozano, another Harvey Mudd graduate, to create accounting and management software for the company. Lozano has created similar software for other clients and knows exactly how to develop what Rodriguez wants. Because there may be no uncertainty regarding the development of the software, the cost may not be R&E cost. Lozano will be paid by the hour, and Spantile will bear the development risk, so the cost will be characterized as software development cost. If the activity does not qualify as R&E for purposes of Section 174, then under Rev Proc 2050, Spantile can elect to treat the costs in a manner similar to Section 174. That is, it can either expense the costs currently or capitalize them. Note that if Spantile was a startup company subject to Section 195 and elected to expense the cost currently, the cost would be subject to 162 but would be deferred under Section 195. Software development costs that are capitalized under Rev Proc 2050 are also amortized under that rule. Software development costs that are capitalized under Rev Proc 2050 are amortized over 3 to 5 years. Capitalized software development costs are amortized over a period of 60 months from the date of completion of the development, or in accordance with rules provided by Section 167F1 and the regulations thereunder, over 36 months from the date the software is placed in service. Capitalized software is also eligible for bonus depreciation, so to a limited extent, such software can be deducted entirely in the year the software is placed in service.